What is a stock? A stock is a small piece of ownership in a company. When you buy a stock, you become a part owner of that business and may benefit if the company grows and becomes more valuable. For example, imagine a company is worth $1 million and divides itself into 1,000 shares. If you buy 10 shares, you own a small portion of that company. Those shares are your stock ownership.
What is the difference between a stock and a share? A stock refers to ownership in a company, while a share is a specific unit of that ownership. Stock is the general concept, and shares are the individual pieces you own. For example, imagine a pizza cut into 8 slices. The entire pizza represents the stock of a company, while each slice represents a share. If you own 2 slices, you own 2 shares of the stock.
Why do companies sell stocks? Companies sell stocks to raise money for growth, expansion, or other business needs without borrowing from a bank. Investors provide money in exchange for partial ownership of the company. For example, imagine a business owner wants to open 10 new stores but needs $5 million. Instead of taking a loan, the owner sells shares of the company to investors. The money raised helps the business expand.
What is an IPO? An IPO, initial public offering, is the first time a private company sells its shares to the public on a stock exchange. It allows the company to raise money from public investors. For example, imagine a successful private company wants more money to grow nationwide. It decides to sell part of its ownership to the public. On the day those shares become available for anyone to buy, the company is launching its IPO.
How does the stock market work? The stock market is a place where buyers and sellers trade shares of publicly owned companies. Stock prices move up and down depending on how much people are willing to pay and how many people want to sell. For example, imagine 1,000 people want to buy shares of a company, but only 500 people want to sell. Because demand is higher than supply, the stock price rises. If more people want to sell than buy, the price falls.
Who controls stock prices? No single person or organization controls stock prices. Stock prices are mainly determined by buyers and sellers in the market. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. For example, imagine 1,000 people want to buy shares of a company, but only 500 people want to sell. Buyers will offer higher prices to get the shares, causing the stock price to rise.
Why do stocks go up and down? Stocks go up and down because of changes in supply and demand. Investors constantly buy and sell shares based on what they think a company is worth and what they expect in the future. For example, imagine a company announces record profits. Many investors may want to buy its stock because they expect the company to grow even more. Increased demand pushes the stock price higher. If investors lose confidence in the company, the price may fall.
Why does the news affect stock prices?
News affects stock prices because it changes what investors believe about a company's future. Good news often makes investors more willing to buy, while bad news can make them want to sell. For example, imagine a pharmaceutical company announces that a new drug has been approved. Investors may expect the company to earn more money, so many people rush to buy the stock, causing the price to rise.
How do stocks make you money? Stocks can make you money in 2 main ways: through capital gains and dividends. Capital gains happen when you sell a stock for more than you paid for it. Dividends are payments some companies make to shareholders from their profits. For example, imagine you buy a stock for $20 per share and later sell it for $30 per share. You make a $10 profit per share. If the company also pays dividends while you own the stock, you earn additional income.
What is a dividend? A dividend is a portion of a company's profits that is paid to its shareholders. Companies that earn consistent profits often distribute some of those earnings to investors as a reward for owning the stock. For example, imagine you own 100 shares of a company that pays a dividend of 50 cents per share each year.
You would receive $50 in dividend payments simply for owning those shares. How does a dividend work? A dividend works by distributing a portion of a company's profits to its shareholders. The more shares you own, the more dividend payments you receive. For example, imagine a company declares a dividend of $1 per share. If you own 200 shares, you will receive $200 in dividends. The company pays this money directly to shareholders as a reward for investing in the business. What's the difference between trading and investing? Trading involves buying and selling stocks over short periods to profit from price movements, while investing involves buying stocks and holding them for years to benefit from long-term growth. For example, imagine you buy a stock today and sell it next week because its price increased. That is trading. If you buy the same stock and hold it for 10 years because you believe the company will grow, that is investing. What is an index fund? An index fund is an investment fund that owns many different stocks and is designed to track the performance of a market index. Instead of buying individual stocks, investors buy shares of the fund. For example, imagine you want to own a small piece of the 500 largest companies in a country. Rather than buying 500 different stocks one by one, you buy an index fund that already owns all of them. Why does the stock market crash? A stock market crash happens when stock prices fall sharply over a short period because many investors rush to sell their shares at the same time. This can be caused by fear, economic problems, financial crises, wars, or unexpected events. For example, imagine investors suddenly believe the economy is heading into a severe recession. Millions of people begin selling stocks to avoid losses. The massive selling pressure causes stock prices to drop rapidly, resulting in a market crash. What is insider trading? Insider trading is the buying or selling of stocks using important non-public information about a company. It is illegal in many countries because it gives some investors an unfair advantage over others. For example, imagine a company executive secretly knows that the company will announce record profits next week. Before the news becomes public, the executive buys shares, expecting the stock price to rise. Using that private information to trade is insider trading.